Equity valuation. Equity valuation in CFA Level 2 focuses on estimating the intrinsic value of common stocks and determining whether securities are overvalued, fairly valued, or undervalued relative to market prices. Candidates study both absolute and relative valuation approaches, including dividend discount models, free cash flow models, residual income models, and market-based valuation techniques. The curriculum emphasizes the importance of understanding company fundamentals, industry conditions, and growth expectations when selecting an appropriate valuation methodology. Candidates also examine the going concern assumption, liquidation value, and the sources of market mispricing. Strong equity valuation skills enable investment professionals to identify attractive investment opportunities, evaluate corporate performance, and make more informed portfolio decisions. The topic forms a core foundation for equity research and active investment management. Dividend discount models represent one of the primary valuation frameworks studied in the curriculum. Candidates learn how to value stocks using single-stage, two-stage, three-stage, and H-model dividend discount approaches. The curriculum explains how expected dividends, required rates of return, and growth assumptions influence stock valuation outcomes. Candidates also study the Gordon growth model and learn to calculate justified price-to-earnings ratios, implied growth rates, and present value of growth opportunities. Significant emphasis is placed on understanding business life cycle stages, including growth, transition, and maturity phases, because these stages influence dividend patterns and valuation assumptions. Analysts must evaluate whether dividend-based models appropriately reflect a company's characteristics, profitability, and expected future performance when estimating intrinsic value. Free cash flow valuation is another major area within equity valuation and focuses on estimating value based on a company's ability to generate cash flows for investors. Candidates compare free cash flow to the firm and free cash flow to equity approaches while learning how financing decisions affect each valuation method. The curriculum explains adjustments to net income, EBITDA, and operating cash flows needed to calculate free cash flow accurately. Candidates study stable growth and multistage valuation models and examine sensitivity analysis techniques to evaluate the effects of changing assumptions. Understanding free cash flow valuation is important because many companies do not pay stable dividends, making cash flow analysis a more reliable indicator of long-term value creation. These methods are widely applied in equity research, mergers, and corporate finance. Market-based valuation techniques emphasize the use of price and enterprise value multiples to compare companies relative to peers and industry benchmarks. Candidates study price-to-earnings, price-to-book, price-to-sales, EV/EBITDA, and PEG ratios while evaluating the strengths and weaknesses of each measure. The curriculum explains how fundamentals such as profitability, growth, leverage, and risk affect justified valuation multiples. Candidates also learn methods for normalizing earnings and applying cross-sectional regression analysis to estimate predicted valuation ratios. Relative valuation techniques are widely used because they provide efficient comparisons among companies and sectors. However, the curriculum emphasizes that valuation multiples must be interpreted carefully, particularly when accounting standards, economic environments, or growth expectations differ significantly across firms or geographic markets. Residual income valuation provides an alternative framework that focuses on economic profit rather than dividends or cash flows. Candidates learn how residual income models estimate intrinsic value based on book value and expected future residual income generation. The curriculum explains economic value added, market value added, and the relationship between residual income and price-to-book ratios. Candidates also study continuing residual income, growth assumptions, and accounting considerations that may affect valuation accuracy. Residual income models are particularly useful for companies that do not pay dividends or have unstable cash flows. The curriculum compares residual income approaches with dividend discount and free cash flow models to help candidates understand when each method is most appropriate. These concepts strengthen analytical flexibility in complex valuation situations. Overall, equity valuation in CFA Level 2 develops comprehensive analytical skills used to assess the value and investment attractiveness of public and private companies. The curriculum combines financial modeling, forecasting, ratio analysis, and valuation theory to strengthen decision-making in equity research and portfolio management. Candidates learn to evaluate business fundamentals, assess market expectations, and apply different valuation approaches depending on company characteristics and investment objectives. The topic also reinforces the importance of critical thinking, sensitivity analysis, and understanding the assumptions underlying valuation models. Strong equity valuation skills enable investment professionals to make more informed recommendations, identify market inefficiencies, and construct portfolios aligned with long-term return objectives and acceptable levels of investment risk.